What is going on, everybody? Welcome to a family live stream, 6 o'clock, the last day of March, the last week of the quarter.
Well, the last live stream.
The last live stream of March. That's correct.
I hope it's not the last day.
No.
A lot of clients supposed to be closed next week. That would be an issue.
Hope you're all doing well.
Yeah.
With all the people jumping on here. What's going on, everybody? Quig, Natalia, what's going on? What up? Thank you for joining. We are also on YouTube and Facebook. For anybody who has any questions, drop them in the chat below. We'll be sure to answer any questions you guys might have. Do you have your phone there? You take
No.
a look? All right. So if anybody has watched our video this week, we dropped 10 tips on what you should know when refinancing your property. So there's a handful of things that you should probably know and that you might not know or consider when refinancing your property. And
I think we even snuck in a bonus one.
we did. It was
If
actually
you watched the
11.
entire thing.
So if you did watch it, then obviously you know what the 11th one is. If you didn't, then we will obviously go through it in this video as well.
No, go back and watch it. Go back and watch it.
We just have a lot of people trying to take advantage of the market at the moment. A lot of people are refinancing their properties, looking to pull that cash out. And there are a lot of questions around how to do it properly. You know, how is it going to affect you? And some things you should probably know when making that transaction. So we decided to break it all down for everybody. So if you haven't watched it or you don't have time to watch our full thing now, go on Matt's channel a little bit later and watch it. It's a pretty sweet video.
Yeah, I mean, refinances really affect. I mean, they affect everybody when you refinance your mortgage. But as an investor, obviously, your situation is a little bit different than the average homeowner. So understanding, like Josh said, how it affects you moving forward, but specifically, what does your cash flow look like from that? What does that mean for your ability to buy another property? There's a lot of things that we just want to make sure everybody is aware of, and making sure you're asking the right questions when you're moving forward with these transactions. And like Josh said, just how they're going to impact you moving forward. So jump right in.
So number one was, how long have you owned the property for? So most people, what they are looking to do, or some people, what they're looking to do as investors is they're looking to burr a property. So you buy a property, and then sometimes a burr can last a year. Sometimes a burr, people want it to last 30 days. So how long you've had the property for, and you're being on title for, is a question that most lenders are going to ask. There is some sort of gestation period depending on the lender. Most lenders want to see you in the property for at least 6 months. So when you are burring a property, it is possible to do it in less time. There are banks who do it. It's not guaranteed. So there are, it is something to consider. Usually, I think the fastest we've done a refi is 3 months out of a purchase. So something to consider is how long you've been in the property. Because if you've been in it less than 6 months, there may be some difficulties being able to take a cash out refi on that property.
Yeah, and this is something that we always try to tell everybody, especially when we're doing the flip product. For a 6 month time period, you really need to be able to make sure that you can, for one, if you're looking to refinance the property, looking to burr it, can you qualify? So we got to make sure that you qualify first, but also, are you going to be able to carry that mortgage for the full 6 months? Because there is no guarantee that you can refinance before that 6 months. So, if you're taking a look at the profit and your profit ends at month 5 or, at month 4, like, hey, we're going to have a bit of an issue here. Just taking a look at how long you're going to be carrying those payments for. Like Josh said, it's not guaranteed that we can get out in month 3. Definitely, anything earlier than that too. There's some people you might be getting into a 1 month, renovation. Hey, refinancing a property at 2 months out, especially out of a private, it's going to be very, very difficult. So just keep those in mind.
For sure. Thing number 2 to consider is value increase. So what is the current value of the property? We are in an extremely bullish market at the moment. Valuations are going significantly over what people had purchased even 12 months ago. In an environment like this, there are banks who are becoming more cautious of extreme increases in value over a short period of time. So what is the current value? What did you buy it for? How much has it increased in from the time when you bought it? And is it viable? I have Scotiabank. I have a client who purchased a property at Scotiabank. They had an appraisal on it of the purchase. Appraisal came in at value, and Scotia still wasn't comfortable with the valuation due to the rapid increase in value. So, understanding what the value is, was it force appreciated? How long did it take you to force appreciate it? Did the market appreciate over time? And just like being able to track and understand the average appreciation in a market over time. Something as a homeowner, it's going to allow you to be able to kind of plan out the trajectory of your personal net worth over time.
Mm-hmm.
If you have a goal of having a personal net worth over $1 million or $2 million, and when you buy a certain asset that's worth X and it appreciates at 7% per year over the term, you can figure out pretty quickly what your goal, how long it's going to take for you to get to your goal. So
yeah, and I think the big issue is, or the lenders have is, like Josh said, what created that value? If it's just market appreciation and you're just taking advantage of a hot market, I've heard a lot of stories where Scotia has been saying no, and some of these other banks have been saying, hey, we know the value has come in, the appraisal value, but we don't want to lend on it, and it's simply just the lender has taken a look at the market and determined, this is too risky for them to move forward with, even if that value is currently there. There's always going to be talk as to whether or not this is a bubble, and the lenders are going to take a look at that. And if you're just refinancing based off of market appreciation because of a market, and you haven't done anything to actually physically increase that value, they may take a look at where that property is, maybe the borrower, how that price got there, and then say, hey, is this just off market appreciation? Yes. Is this too risky for us to lend on? What are the prices going to be looking like next year? Versus if you've actually force appreciated that, that house isn't going to change. The renovations you've done aren't going to go away next year. They're still going to be there. Whereas market appreciation, may not be there. So that's kind of why you're hearing some of these lenders say no to these property values, even if the appraisal comes in on point.
For sure. Aaron, you want to take number 3 away?
Number 3 was, how does the refinance change your cash flow moving forward? Which is actually a really good point, and something that is very specific and important for the investors to take a look at, especially in a market like this. We just went through some of the lowest historical rates ever on the mortgage market. A lot of people were getting either an insured or an uninsured property for sub 2%. Some of them were around 1.5 to 1.8 for these uninsured or insurable type deals. Those rates probably aren't going to be the same rates that you get when you refinance your property. As we know, market shifting a little bit, we're starting to see the rates go back up to a more normal market area, around that, low 2s to mid 2s, depending on which lender. Understanding, hey, it's great that you got this 1.5 or 1.6 and now your cash flow is huge, but when that rate goes up 1% and you're refinancing 1% higher, to force appreciate that property. And, if you take out a full 80, 75% loan to value, what does that look like for your mortgage payments? And what does that look like for your cash flow? Not every property that we see coming in from the client has super strong cash flow. We see some that are only cash flowing, $300-400 a month. When you increase that and your mortgage payment is $500 more a month now, hey, that $500 cash flow, that's gone now, right? If you have $1,000 cash flow and your mortgage payment goes up $500, which isn't really too far away from the average. If you look at a situation like this, coming from 1.7, 1.8 to a low 2 to mid 2 on a much higher loan value, that's not unreasonable to think your mortgage payment couldn't go up $300 to $500. So depending on where you're at right now and what the rates are going to look like from a year from now, just understanding how that's going to affect your cash flow. And, most times you're probably going to see some sort of reduction in cash flow unless you're coming from high rates to that low rate, or if you can keep the rate the same, or playing around the amortization. But in most circumstances, there is going to be a bit of a deduction in cash flow.
Yeah, that reduction in cash flow can be offset by a longer amortization when you do refinance. If you purchased a insured mortgage, you obviously can't have more than 25-year am, but on your refinance, it's uninsurable, which allows you to push your amortization out, even with the low rates and an increase in rate. Something to be extremely cautious of, because very quickly when a market flips and rates start to go up, you could be in a situation where you no longer cash flow positive, which would not be great as an investment.
And one of the advantages that you can get on the B side, other than all the offsetting and TDS, is some of them do have a 35-year amortization, which, in some situations may be a better option, even though you got to pay some fees on the B side. How much are those fees compared to being negative cash flow or positive cash flow? So something to take a look at if you're assessing your values and the numbers are looking pretty tight. Maybe you pay the 2%, you get into the B side, and we put you in a 35-year amp and reduce the payments a little bit more. Make sure that cash flow stays positive.
For sure. We got a question here from Sean Quick from Carson Law. Are there any institutions that are easier to deal with on a refinance than others? Yes, there are. From a back end and a front end, some banks are just notoriously have not great customer service. Some do have great customer service. On a back end, there is definitely an advantage to us to having relationships with some of the banks that we work with. Our ability to be able to communicate with an underwriter, our ability to be able to have an answer to a question instantly is the slight edge that we need to ensure that your deal gets done effectively. So on the back end, 100% there is not even just like conventional lenders, B lenders, private lenders. There are top tier and there are low tier, and we try to obviously deal with the top tier lenders to allow us to be able to effectively get deals done efficiently and without any hiccups. So 100%.
Yeah, and some lenders aren't even accepting a refinance right now because everyone's so busy. I think was it Equitable?
Yeah, Equitable
Equitable's not doing refinances right now. So some lenders have just shut it down and saying they're not accepting it right now. Or the turnaround time is ridiculously long. Like MCAP was quoting 3 weeks for turnaround time on refinances in terms of even just submitting the deal in and getting feedback and getting to the approval. So refinances, because in most situations they don't necessarily have a firm date unless you're doing some sort of refi and a purchase where it is reliant. Refinances, they tend to push them a little bit and take a little bit more time to get them done just to help operations on the purchasing side from the lenders. For sure.
Naren, I saw your question twice. Just shoot us a message. We'll be able to get in a little more detail. It's a more complicated question than a 30-second answer. We have a few questions coming in from YouTube as well. So if paying 5% down and having to be insured, would that be a smart decision if you're going to refinance in 6 months into a non-insured mortgage? No. Well, unless it's a huge lift. So what's going to essentially happen is, so you put your 5% down, you want to insured owner-occupied property, and you want to BRRRR that property. You put your 5% down, the insurance premium on that purchase is 4%. So you have a 1% equity position in the property on purchase. You're going to have to increase the loan to value at least a minimum up to 80. So 19% appreciation on the asset before you can even tap into the equity. And there's probably another 20% you're going to have to make to actually make it worth your while in the transaction. You're looking at about a 39% increase in value. Now, if you bought it under value and you have the ability to force appreciate it that much, it's a cheap way to get into a BRRRR, but you are having that, you have to factor in that upfront insurance premium that you pay to get into the property, which 9 times out of 10 doesn't make sense. So it's not something I would recommend, but if you find a really, really crazy property and there's a lot of upside to it, maybe possibly just run the numbers.
Yeah, and not only that, but you're also paying that tax up front as well too. So to pay all that on an insured mortgage just to refinance out 6 months later doesn't always make sense. Again, obviously it depends. Like you have to have the 20% down. So if that's not an option, and the 5% down is your only option, we'd really have to take a look at it. Like Josh said, it really does depend on where those valuations come in at, though.
Back to our top 10, we got number 4, who holds your current mortgage? Really important to keep in mind when you want to refinance your property. So is it a conventional lender? Is it a B lender? Is it a private lender? Each individual lender has their own parameters when it comes to trying to pay out the other lenders. So, for example, there are B lenders and A lenders who will not allow you to take a cash equity takeout out of a private loan. So, for example, if you got into a flip or BRRRR with a private loan and you wanted to do that BRRRR and then pull cash out on top of paying out the mortgage, some lenders would have an issue with that. You are able to pull cash out and to self-direct it or have it directed at the lawyer's office to pay out certain debts, but they won't allow you to pull cash out with that bank. So knowing who holds your mortgage and the parameters around how it's going to affect your refinance moving forward is something that you as a consumer probably wouldn't know, but something your mortgage broker should know. So definitely a question to ask when looking at refi.
Yeah, absolutely. Number 5, does your current mortgage have a bona fide sale clause? Which is a really good question. So if you get into a mortgage and you have a bona fide sale clause in that mortgage commitment, you can't exit your mortgage unless you sell your property. So they need, like it says, a bona fide sale of the property for you to be able to break that mortgage. Obviously, that would put a damper on any sort of fast turnaround, or depending on the term of your mortgage. If you were unaware and you locked yourself in on a 3-year or 2-year or even a 5-year, which I've heard of, now you're stuck in that term. You're stuck in that mortgage for the next 3 to 5 years. You're not breaking that mortgage unless you sell it. I have heard there are some lenders who you can request an exception and they may allow you to get out. But again, that's on an exception basis and that's not guaranteed. So your mortgage broker should know at the time of when you go over your commitment with them, hey, do I have exit privileges, or am I locked in this for a year? Am I locked in this for 5 years? And sometimes it's not a huge deal. If or if you're going to be okay with being in that mortgage for a year, you do a 1-year term. I'm doing a mortgage for a client right now where we needed a very particular lender to get it done, and their rental products were bona fide sale clause. They were okay with being in the mortgage for the 1 year, and then after the 1-year term is up, they're just going to refinance out on renewal and not have to worry about any exit penalties or the bona fide sale clause. So just understanding how it works, knowing first off whether you have that in your commitment or not, understanding how it works and what options you have, really crucial to understand.
So something that most people don't know is, those big giant billboards and all those things that you see popping up saying like 0.9%, like super low rate. Those are bare bones. Those most likely 90% of them have bona fide sale clauses in them. So you might be sacrificing a little bit on a rate, but you're also locking yourself into a loan that you probably don't want to be locked into, because the cost in the back end is 5 times as much as it's going to cost you over the term of your loan to take a little bit of a higher loan with something that actually has prepayment privileges attached to it.
Yeah, and if you're ever looking at your mortgage commitment, or you hear your mortgage broker talk about a rate option plus, those typically have some sort of a bona fide sale clause in there most of the time. Essentially, they want to be able to lock you in. They offer the really high rate, or the really low rate, bottom of the barrel on the attraction part. You get in, and that's how some of these lenders keep people in their system. So just keep an eye out for that. If your mortgage broker talks about anything, like I said, rate option plus, or you think it's a super low rate, just make sure you're able to exit out without any issues.
For sure. So number 6, what type of mortgage do you have? This is really important when you're looking, probably the most important when looking to refinance. So you either have a fixed, a variable, or an open. A fixed rate, depending on where you're at in your term, you're either going to have an interest rate differential or a 3 months interest penalty, whichever is larger to break your loan. It could get very, very expensive if your interest rate differential, if you're at the very start of your term and you're in a fixed closed term, it could get very expensive to break your loan. That's how you hear people saying, I have $20,000 to break my loan. It's because the interest rate differential is so large because they're at the start of the term. Now, if you have a variable rate, 99% of the time you have a 3-month interest penalty to break your loan, which is usually marginal. You take on the overall risk of taking a variable rate because the market may go up and down. You may have variability in your payment, but you have more flexible prepayment options. An open term is quite literally just an open term. You usually pay a premium to have a fully open term with the lender, but it allows you to not have any penalty to break your loan.
Yeah, and as important as it is to know, what your current mortgage is, it's also important to decide, obviously, what mortgage you want to get into. Like we talked about a couple points earlier, we're taking a look at how the refinance is going to affect your cash flow. If you're refining into a mortgage where your cash flow is diminished, and maybe you're at $200-300 a month now, maybe a variable rate isn't the best option for you, just because there is that potential for your mortgage rate to go up. If you're at a point where you can't afford that, and you're coming out of super low rates like we're at right now, and there is increased potential for that rate to start going up, maybe locking in at a 5-year fix gives you that steady cash flow, and you don't have to worry about any decreases in cash flow every other month. So just something to consider, just anything that's going to potentially change that cash flow, worth looking into and worth considering. Number 7 is just use of funds. What are you going to be using these funds for? We touched back a little bit earlier on a couple of points there where coming out of a private, they need to self-direct or have these funds be lawyer directed. So they need to know what you're using these funds for. Or are you going to be buying another house? Are you going to be paying your debt off? What are you going to be doing with the money? That's something they're going to want to take a look at and just have an understanding of. Lenders have cracked down a little bit on just giving out free equity over the pandemic and COVID. It is just, they see it as a little bit of a liability and a bit of a risk, giving someone a whole bunch of money without really knowing where they're going to put that money, what they're going to do with it. There is a risk that client goes out there and spends that money on something that does add to their monthly liabilities, does increase their chances of potentially not being able to pay a mortgage on time. So that's where the lender's coming from. They just want to know what that money is being used for, and is it going to affect your ability in the future to be able to repay their mortgage? That's really what their concern is. They don't care necessarily about what you have going on in your life. It's just, is this going to be going towards something that's going to impact their liabilities, impact their debt, and impact their ability to repay our mortgage back?
For sure. Kind of sound like a broken record here, but what are your goals? There's a handful of different products available to you, especially when you're refinancing and you have equity in your home. So, home equity line of credit, does it make sense for you? Like, if you have enough equity, there are products out there that start at a $1 home equity line of credit. As you pay the loan down, the principal amount you pay down every single month increases into a home equity line of credit. Now, it might be small at the start, but as you pay down your loan, that increasing line of credit is your availability to have decently cheap capital available to you, which is, as an investor, that is the name of the game. So, figuring out, can I get a home equity line of credit? Definitely. Second is interest only. There are lenders out there who do offer interest only loans. Some people might be asking, why would you do that? There is a strategy out there specifically for interest only to maximize cash flow on properties. Very few conventional lenders allow it, but it is out there in the market for people who can qualify. And last but not least, are you moving from a variable to a fixed rate for cash flow purposes? Now, variable, obviously the majority, probably I'd say 90% of our investors take a variable term specifically for the prepayment privileges that it allows. But in a market like this where you may see a very rapid increase in prime rate, at some point, whenever the Bank of Canada decides to increase rates, there may be some merit as to locking into a fixed rate. So if you have a mortgage that you can do that with, keeping an eye on the market and keeping a finger on the pulse to make sure that you're in a situation where it's not going to jump up to a point where you no longer have any cash flow to property is super important. If you have a mortgage broker, your mortgage broker is probably going to call you and tell you where you're at in the market. So if you don't have your mortgage broker's phone number, you have ours below. Give us a call. We're happy to help.
Point number 9, closing costs and fees. So, are you refinancing from a private into a B loan, or are you refinancing into an A lender? And understanding the differences between those two and how much extra fees and costs you're going to have associated with each. On the A side, there are no lender and broker fees, so you don't have to worry about paying anything else outside of your lawyer costs. But you will still probably have some sort of cost to break your mortgage. Even on a private mortgage, some of these lenders, most of these lenders typically have a 3 months interest penalty, even on the private side. So just, again, going back, understanding what type of mortgage you're in and what type of exit fees. If you're exiting out of a private and you need to utilize that rental income and we have to get you in on the B side, there are 2% fees involved. There's 1% for the lender, 1% for the broker. Lawyer fees are still the same, and you're going to have your exit cost of getting out of your mortgage. So again, there's going to be some additional costs there. Just understanding all the fees associated, how that's going to affect your equity pullout. If you're expecting an A lender, but you can't get in on the A side and you have to get on the B side, but those funds are being used for a property purchase, hey, you're going to have to come up with a little bit of extra cash for the down payment because those fees are now going to be taken out of your proceeds. So just understanding how much cash you're going to have to allocate to your refinance, what extra fees and costs are going to be associated.
Yeah. Number 10 is standard charge versus collateral charge. So This is something that you probably won't catch on your commitment, but your broker should know which lender does what. So a standard charge is quite literally whatever money that they give you, that's what they're going to put on your title for charge. So if they give you $500,000 for a loan, they're going to put $500,000. Now, there are quite a few lenders out there who do something called a collateral charge. So they will use the global limits. Meaning they will make a charge of 100 up to 125% of the value of the loan amount that they give you on title, meaning the amount that they have registered on your title is worth more than the actual value of your property. Now, they may tell you that it's because as your property grows, they can increasingly give you the ability to be able to tap into that equity. But it also does stop other lenders from putting secondary charges on properties because there's no actual equity built into the back end. So if you're an investor and you're, say, locking into a 5-year fixed product, and you expect appreciation over time and you want to use it as a tool, but you wanted to factor in the fixed payments, it may make sense to just get a standard charge mortgage, because if that house value grows, you may have a little bit of equity there to cross collateralize or use for something else.
Mm-hmm. Yeah. Scotia, I think, is really bad for, or maybe it's just the individual agent, but I have heard of a lot of lender or clients not knowing that they were in a collateral charge mortgage, and they only find out when they go to either do a refinance or they go to do a second mortgage, like a private second. We would take a look at what's registered, and we notice that it's much higher than what they initially thought, and it does play a factor. If you can't put a private second on there to pull out that equity, now you're stuck looking at doing a full refinance. And same with doing collateralized private mortgages. If you wanted to tap into the equity, tag it as collateral and help increase your loan to value on a private purchase, and you have a 125% collateral charge mortgage on there from a bank, that equity is gone now. We don't have access to that. So understanding what types of mortgages you're getting on your property, and just knowing, hey, moving ahead, you're going to have 120% registered. Or nope, hey, this is standard charge. You're only going to get your principal amount registered. All the other equity is still going to be available.
Bonus number 11.
Private collateral. So one of the things that we wanted to talk about was basically what happens if you have collateralized your mortgage or one of your properties and tagged it, and it's part of a blanket private. That equity is now the lender has claim to that equity via the mortgage commitment. So you're not going to be able to put a private second on that mortgage. You're going to have difficulties refinancing that house. You're going to have difficulties using all the proceeds out if you go to sell that property. Whether you refi, whether you sell, the lender has a claim to that equity. And if you do that at the lender's office, when they do the statement of adjustments, there is going to be a set amount of money put aside that's worth that equity that they have the claim to, and it's going to be held in trust until that collateral mortgage is taken off the property. It is a lien, so they do have access to it, and they do have the right to put the access to it. And that's just something that you need to understand before getting into these is that equity is going to be tied up, whether you want to refinance, whether you want a private second, whether you want to sell. There's going to be a set amount of equity and proceeds that's set aside.
And we're not shy about telling you the disadvantages of using cross collateralization either. There are tons of advantages, not having to break your mortgage and using the equity. But the disadvantage is if you have a second charge in that property, you can't refinance that property or you can't sell that property. So being aware of where you're at in your specific plan and where you're at your term before using that piece of collateral is extremely important as well. So all things to keep in mind. We do have a few questions from YouTube. We have a few here. So from Philip, who said, can you force appreciate and do a refinance in as little as 2 months in a hot area? I have seen clients do flips in as little as 1 month. Can you do it in a hot area? You can do it in a hot area and not a hot area. You can do it essentially anywhere. I definitely advise knowing your comps, knowing your ARV, dialing in your overall cost, and understanding what it's going to take to be able to execute properly. Having the correct product specifically for your flip is also a huge staple in what you in how to successfully exit a flip. So you can do it for sure. I do recommend, obviously, looking at the market. we love doing business. I would love to continuously do business in a market that goes parabolic forever, but we're also not naive to understand what's the market that we're in. So purchasing property right now, on a flip with a leveraged product, just understand the lift that you have and the time frame that you're in.
And again, 2 months may be doable, not guaranteed. So just keep that in mind as well too. I have heard stories, but it's just not guaranteed.
For sure. Got Addy here. How do lenders feel about using refinance cash into a stock portfolio? So, when we tell a lender what we're going to be using the funds for, we just tell them we're looking for alternative investments. They'd much rather obviously have you use those funds. Now, if it's a large amount of money, they may force it into an account directly from the lawyer's office and not give it to you in cash. But they're usually okay with having directed funds into an investment account.
Yeah, on refinance proceeds, the typical rule of thumb is anything under $200,000. $200,000 is kind of their limit as to what they will just give as free equity takeout. Now, again, that doesn't mean that you can just ask for $199,000. They're just going to give it to you without asking any questions, but they're always going to want to have some idea. Anything above that, though, they're going to start to need, it's going to be a little more strict. They're probably going to want things lender directed. So, that's fine. Yep. Whether you want to put in investments, whether you want to put it in your TFSAs, your RSPs, those are all acceptable reasons for pulling out the cash from a refinance.
Yeah.
Josh Norris, can I put a second on my principal resident if it is a fixed bona fide sale mortgage? So as long as there's enough equity in the property, then yes.
Yeah, because it won't necessarily affect breaking the first mortgage to put the second on it. You would just have to be concerned about if you were to refinance and pay out the first mortgage, and then it would cause obviously an issue down the line, but it shouldn't affect your first mortgage. Now, obviously, read the fine print on all of your first mortgages to ensure that they're allowed to put seconds behind them.
On Instagram here from Roman Singh, are there any impending announcements coming from the Bank of Canada regarding prime rate that you know of? So I did hear the other day that they are starting to stop the credit programs that they had. So the Bank of Canada and the government had put together programs when COVID first started to help make sure that the credit markets remain free and flowing. Those programs have been in place for the last year and a bit now, I guess, or a year. Now that the market and the economy seems to be somewhat stabilizing, they have started to pull back some of these programs, and they will be stopping them. So, they're not coming out and saying that the rates are going to go up, but the programs that they had in place keeping these rates low are going to be stopped. So, that could be the initial the starting point of the prime rate going back up a little bit.
Yeah, crazy times. We specifically wanted to make or have a conversation about this because we are getting a ton of people who are looking to tap into that equity. So if you guys do have any questions about the situation, how to refinance or your current situation or what lender would be best to look at in your situation and product, feel free to reach out. Let us know in the comments below or just shoot us a DM. We'll try to get back to you as soon as possible. Other than that, I think we're going to cut it off here, guys. And if you guys enjoy your Sunday, the last week of the quarter. If you guys are in sales, crush your goals. You guys have a few days left. Thanks everybody for tuning in, and we will see you all again next week.
Thanks, guys.
Cheers. Bye.